Hi, welcome to Mark in a Minute. I'm Patrick Adams. On Wednesday, Micron reports earnings. So Micron produces commodity semiconductors. I think, and the stock's been wildly positive this year. I think this is a critical number on Wednesday. So it's very critical for the technology stocks that this company reports a nice upside surprise and guides up significantly higher from this level. Inflation. Inflation's topping out. Yay. I think the financials are also catching a bid, so they're acting much better. So the inflation topping out is really important for the overall markets, and it's important so the Federal Reserve can begin to bring down interest rates maybe later this year and then the next year. Viking Therapeutics. So I met with them on Monday. We think they have the best in class obesity drug by far, and we're going to see a lot of data coming out over the next 18 months. So really like this company. Disclosures, please read through this at your convenience. And then market update. So Trump, without question, he needed to do this deal. Okay, maybe this is not the greatest deal ever with Iran, but it's solving the problem. And I think if he has to, he'll come back after the midterms and finish the job if he needs to. So two reasons why he did it. One is to get things resolved before the midterms, so gasoline prices come back down and put a top in terms of the inflation numbers. And then secondly, we think that he can come back and wipe out the IRGC, but he needed to do this prior to the election. We find it interesting that Rubio is nowhere to be found with this agreement. So they put Vance out there instead. I think Rubio didn't like it, is my read of all this. The technology sector is in a bubble. I know we've said this quite often in the last a month or so, but it's in a bubble. And it really needs these commodity chips to continue to do well. That's where all the momentum is in the technology side of the markets right now. So again, Micron reports on Wednesday. Expectations are $20.70 per share, and then the revenue is 35.6 billion. So it needs to come in a lot better than that, and more importantly, for them to give a much higher estimate looking out. So the stock market's thinking that you don't get supply and demand imbalance for these commodity chips until maybe 2030. That's a long time, and you're going to see quite a bit of capacity come on in the next couple years. So if you look at what's going on here, it's basically all been driven by price increases. Not all, but mostly. Demand's been good, but the price increases have been the majority of why estimates have gone up so much. So you can see back here, basically at the start of 2025, the DRAM prices, that's a black line, they were roughly about $1. And now they're almost $14 per chip. So that's a 14x increase in prices. And you've seen a big increase in the earnings estimates. So we believe over time, as supply and demand comes into balance, so instead of earning $80 a share annually, they're going to earn something like maybe $8 per share. So, the market at times can look out, pretty far in advance, and other times it doesn't, just rises momentum. So we think right now, $80 to value this company is way too high. We think more like, $8 times maybe a 10 multiple, which would be basically 90% lower than where the stock is currently. So that's ultimately the risk in this stock over time. Walsh had I think a good press conference last week. It was kind of right down the middle, not hawkish, not dovish. I think that's the message he wanted to give. Many people on Wall Street thought it was a hawkish press conference. Well, we didn't see it that way. And I think over time, as these energy prices come down quite a bit, it'll open the door for them to cut interest rates. Right now, the bond market's expecting at least one, if not two, rate increases in the near term. Now, if you look over here, this is CPI. This is for the month of May, and you know all energy prices were up about 23% year over year, and then motor fuel, energy, commodities, gasoline, all up over 40%. So what's happening is we're going to see these turn negative and likely turn negative in a big way, and then help all these other items that are in CPI in the coming quarters to alleviate the pressure on the underlying inflation rate. So this is very positive. Again, it will allow the federal funds rate to come down over time. And we're seeing right now the banks and or financials start to get a bid. This group's starting to act better. And then we will also expect the consumer stocks to act better as well. Disney would be one of our favorites in the consumer area for a high quality, not home run. This is a single or a double, but a lot of sponsorships coming back to the stock as there's a new CEO and Wall Street likes what he's doing. Now, I think this chart here is really interesting. I wouldn't call it a good indicator, but you look at the last 13 changes in the Fed chairman, every single time for the next 3 months, the market's down. You know, the best one was under Bernanke, and the worst one was under Greenspan. But by and large, even if you throw out these outliers, you still have the market down on average every single change of fair chairmans. So what we get out of this is maybe the market is due for a correction, and we just happen to also have a change in Fed chairman, like we did in 1987 with Greenspan. That was set up as well to have a pretty ugly first 3 years under first 3 months under Greenspan. So don't take this as gospel. It's not a great indicator, really, but I think it's really interesting, in my opinion, that every single time that the market's been down under a new Fed chairman. So maybe it's timely that we see a correction in technology and to put pressure on the overall stock market as well. So emerging healthcare, in our emerging healthcare strategy, I would say that every single stock that we own in there, not many, we're pretty concentrated, but every stock has over the next 12 months at least 100% upside potential. So it's timely for these stocks. We have not performed all that well this year. Last year was terrific. This year is not, and we think probably between now and then year end or now and 12 months that portfolio performed really well. But one thing that was announced last week that was interesting, and we've highlighted this company before, is Butterfly, BFLY. They have this handheld ultrasound device. Okay, so this is the current devices out there. These big racks, right, on a cart, and they're very cumbersome. And so if you go into some hospitals have this, but if you go into a hospital emergency room event, they could bring out this little small device, handheld, and do a whole body ultrasound very quickly to find out what's wrong with the patient if they don't know already. So Butterfly is accelerating this technology. They're using an NVIDIA chip to help with the AI screens. So there's another company that's going to commercialize this into centers, wellness centers. So if you go to a wellness center, they try to prevent your illness from really becoming a problem. So catching it early. So ultimately, this will be able to do, screen for masses in your body and find it reasonably early. So the technology is new. It's going to replace this large embedded market of ultrasound machines into these little small handhelds, very convenient to use, and they work a whole lot better than what's currently on the market. Viking Therapeutics, okay? We had a really good meeting with them on Monday. This is a high conviction idea. I know it's a $3 billion market cap. We generally buy, stocks in this emerging healthcare that are much lower market cap. We've known this company a long time, and we've done well with it. So recently we bought it back in the 20s. I think it's compelling. The reason why it's compelling, if they have this dual receptor for a obesity drug. So if you've heard of the GLP-1 drugs, well, this also has a GIP receptor with it. So it's dual action. There's less side effects, and it works better. So you get better results. So this is a better drug. The oral drug is coming out before year end. Okay, so we'll see that data around January. We'll see this data come out. So this is going to be a big deal. This is phase 2 data. It'll be the best oral drug when it's finally approved. But phase 2 data coming out in January. That'll be a big catalyst for the stock. They have some other data coming out, in the third quarter, and then lastly, the big data will be their injectable, and that'll be phase 3, and that'll be late in 2027. So this could be, the big mover for the stock. Stock's trading around, 3.3 billion market cap. I think you could see, 3 times return over the next 18 months, providing everything goes reasonably well. So like this one a lot. It's probably, if it's not our biggest, it's close to it. It's maybe our second biggest drug in our emerging healthcare, and then we have it in other strategies as well. So we're very positive on this, and think the stock can move up nicely over the next 6 to 12 months. So if you have any questions, come to my website, Patrick Adams CFA. You can ping me from there. Go to PVG Asset Management as well. You can see the strategies that we manage. And then, as always, if you have any questions, just ping me off the video. Thank you very much. Take care.